Hello, and thank you for joining us in our webinar today on how to evaluate a voluntary separation package or an early retirement offer from your employer. Whether you have received one of these offers or maybe just think you might have one coming, it likely got your brain racing because there's a lot to consider when evaluating these offers. They might involve several weeks or several months of pay and extended benefits, which is great, but it also means you may be forced to retire earlier than you anticipated or be stuck finding a new job late in your career. So this is an important decision to get right and one we want to make sure you're educated about. First, you should know who we are, what we do, and why we think you should listen to us. My name is Matt Hilland. I'm a partner and financial planner here at Arnold & Moat Wealth Management. We were established in 2000 by Eric and Jean Moat, who later joined with Quinn Arnold. With that experience, we're one of the Iowa Corridor's longest standing fee-only fiduciary financial planning firms. And from being around that long, these severance offers are something that we've seen and helped others through many times. We've helped those at Rockwell Collins, now Collins Aerospace, John Deere, Procter & Gamble, and other big employers in the area. We've helped evaluate their early retirement packages. And fee only means that we take no commission from any of our recommendations. That means when you come to us, we aren't trying to sell you anything. We don't try to sell life insurance or specific mutual funds. We just offer the planning advice that you need. By far the main question on someone's mind who receives a voluntary separation offer is whether or not they are ready to retire yet or not. And that's the question we are here to help you answer. But the answer to that question is dependent on a lot of things. And if you notice, a lot of these items are going to be impacted by the details of your separation offer and whether or not you accept it. We're going through the impact in detail over the next couple slides, but a quick overview is here. Your retirement savings is the big one. This is your 401k, your IRA, Roth IRA, and this will likely support much of your retirement. You might also have some amount of fixed income in retirement, Social Security, of course, and maybe a pension as well. Another important factor in your retirement is your spending. If you have $1 million and only need to spend $20,000 per year, you might be in good position to retire. If you want to spend $120,000 per year, you might need to reconsider. And then besides general spending, you probably have some big one-time purchases or goals in retirement. Maybe you envision a house down south or traveling the world. All of these items come together to create your financial plan. Now, in a perfect world, it'd be easy to put these numbers in a spreadsheet and determine whether or not they will last you through retirement. And you can try if you want, but that really doesn't work in the real world. And that's because there's a lot of uncertainty in all of these numbers. Your retirement savings is invested in the stock market. It goes up and down, and while we're confident over time can produce satisfactory returns, it can be volatile, and that can be troublesome or nerve-wracking for a retiree living off their investments. Your source of fixed income is pretty well known, but there's still a lot of decisions to make around them. For Social Security, for example, and perhaps even your pension, you'll be rewarded for delaying. Should you delay to get a higher payment on these or take them now to avoid drawing down your retirement portfolio? And also you need to consider how inflation will impact these over time. You might have an idea on what your spending is today, but how might that spending change in retirement? If you're under age 65, then depending on the specifics of your early retirement offer, you may have added healthcare and insurance costs before you're able to enroll in Medicare. Then once you're in Medicare, how much will Medicare cost? You have supplemental policy plus a drug plan plus deductibles. It's important to plan for all this. When we help clients analyze these items, we use something called Monte Carlo analysis, which factors in things like stock market volatility and inflation, and allows us to see how your retirement assets hold up in a number of different scenarios. When retiring early, you add a lot of uncertainty to your plan, more years of stock market volatility, more years of your investments needing to support you. So when considering your early retirement offer, these are all items you need to consider. So let's go into a few of these topics in more detail and how your early retirement offer can impact them. The first item is your retirement savings. An early retirement means that you're probably going to stop contributing to these accounts sooner than you had planned and begin withdrawing from them sooner than you planned. So it's important to know what your retirement portfolio is able to sustain. If you aren't prepared, retiring early can be a real double whammy on a retirement portfolio, since you lose out on years of growth and contributions and you add years of withdrawals to your portfolio. Then you also need to consider how to manage your cash flow with the savings. If you accept a retirement offer, the days of a paycheck hitting your bank account are over. How do you convert this retirement portfolio into investments that can safely provide you cash through retirement? And you have a lot to consider on how to fund your retirement. Money taken from your 401k or IRA are taxed very differently from a Roth IRA or even your taxable brokerage account, for example. And the different investments in these accounts can also cause different tax liabilities for you. So step one is to make sure that if you accept the offer, you have a withdrawal plan in place that is sustainable and tax efficient. If you accept this early retirement offer, your tax picture along with your risk profile looks very different than what you've probably been used to over the last few decades. That means how you are invested going into retirement might need to look quite different than it does now. Accepting an early retirement offer opens up a lot more investment options for you. You'll be able to roll over your 401k into an IRA and access thousands of more investments and likely many more low-cost options than your employer's 401k plan had. This gives you a chance to increase your diversification and lower your expenses to help make your retirement portfolio last. Lastly, recognize that you face a different set of risks regarding your investments now. You need long-term growth to support a long retirement, but you probably also prefer safer investments now since you are losing the ability to save in these accounts or stop withdrawals if the market declines. And you need these accounts to begin producing income for you, but you need to do it in a tax-efficient manner. So your next step, if you're considering accepting a voluntary separation offer, is to do a good check on your investment portfolio. Decide if you need to make any changes, identify the risks that you have, and how to structure your savings for the best results. Now on to the income component of your retirement plan. Almost everyone will be eligible for Social Security in retirement, and if you have probably received a statement that looks just like this that details how much money you can expect from Social Security depending on when your benefits begin. But if you accept an early retirement offer, these numbers might not be what you actually receive. These numbers assume you have your most recent year's earnings until you begin Social Security. So if you're accepting an early retirement offer at age 62, the number of your full retirement age amount shown on the statement is assuming you work and earn the same income for another 4 or 5 years. If you are retiring early, that means you'll have less earnings than this statement assumes, and therefore your benefit will likely be lower as well. Exactly how much your benefit will be impacted will depend on your work history. If you have a couple of decades of work at a similar salary, the impact might be small. If you only have a couple years of income at your current salary or a short work history, the impact could be much larger. We have several Social Security tools to provide you an accurate projection of what your benefits will be. This is incredibly important because this ripples through your entire plan. Lower income than you planned on means you need to either spend less in retirement or draw harder on your retirement portfolio. Both of these scenarios can lead to a different retirement than you were expecting over time. Now, of course, we hope you reach out to us if you need help, but you can do some of the Social Security analysis on your own if you want to. On the Social Security website is a retirement estimator calculator. You can enter your past earnings history and then alter your future earnings to simulate an early retirement scenario and see how that impacts your Social Security numbers. You want to do this to get an accurate estimate of what your Social Security payments will actually be. You have another important decision with Social Security, and that is when you begin to receive the benefits. Now, if you accept an early retirement offer, you might be tempted to claim Social Security as soon as possible to help give you some income, but that can have significant long-term consequences. That is because every year you delay Social Security, your monthly benefits increase. On average, it's about an 8% increase for every year you delay. And over time, through your whole retirement, this can result in a very big difference in the total amount of benefits you receive. For many, the difference between taking Social Security early compared to delaying is a several $100,000 difference at least. So this is a big decision. If retiring early is going to require you to begin Social Security at age 62, for example, that will have a huge long-term impact on your financial plan. Some similar considerations need to be made regarding your pension if you have one. You likely have a decision on when to begin your pension, and like Social Security, taking it earlier will likely result in a lower total lifetime payment. If you retire earlier, then you're probably getting less credit towards your pension, which can permanently reduce your benefit. Your voluntary separation offer may give you some additional credit towards your pension, but it will likely be less than had you continued working for a couple more years. And besides the years of work credit, you may also be offered increased benefits for delaying, even if you don't work there anymore. Like Social Security, you should carefully consider the trade-off of taking a pension early and its impact on your benefit. Lastly, there are many options or features that companies can provide to you regarding your pension. The most common is a Social Security bridge or offset, which pays you increased benefits until you start Social Security. But the trade-off is that later in life, your benefit will be lower. All of these decisions are important, and one that you may have to make quickly if you're considering an early retirement offer. But it's important to think through because they can mean the difference of tens or even hundreds of thousands of dollars in total benefits. Moving down our original list, next up to consider with your early separation package is how you will handle the healthcare expenses if you accept the offer. Healthcare is going to be one of your major expenses in retirement, and if you or a spouse loses access to your employer's health plan, it can increase your costs substantially. So one big factor in whether or not early retirement offer made to you is a good one is if it helps you bridge the gap between retirement and when you're eligible for Medicare. You may be allowed to stay on the workplace retirement plan. That would probably be preferred, or they may just offer to help pay some of the costs. You also have the opportunity to buy healthcare through COBRA. COBRA can help you bridge the gap and keep you on your current plan for up to 18 months, but it will be very expensive. However, if you're happy with your plan or you just have a short period of time before you turn 65, it still may be your best option. If your separation offer does not include healthcare or you're still faced with very high healthcare expenses, you may want to look at healthcare.gov, which is the government's ACA healthcare marketplace. Here you can type in your age and location and receive instant quotes for different health insurance policies. Before you accept or reject your early retirement offer, it may be wise to go here just to get an estimate on how much healthcare could cost you. Healthcare.gov will also tell you if you qualify for any subsidies or reduced premiums for your health insurance, which might help reduce your payments even further. We also wanted to mention some opportunities that you will have by accepting this offer and retiring early. As we said earlier, a lot of things change when you retire, and your tax picture is certainly going to be a big change. Because of this, if you have a majority of your retirement savings in a tax-deferred retirement account or a 401k or traditional IRA, right after you retire becomes an opportune time to take advantage of your low income and your low tax bracket and perform Roth conversions to get some of that money out now at a lower tax rate. We can't go through all the details of what goes into a Roth conversion plan right now, but we do have a detailed blog post and another webinar recording on the topic. If you go to our blog and select the tax planning category, you'll see our post on Roth conversions. And that post also has a link to the webinar we did with much more detail. And lastly, the other big tax status change you need to know about in retirement is that depending on your income, you may qualify for 0% tax on long-term capital gains. This means if you have investments in a taxable brokerage account, you may be able to sell these investments and pay $0 in tax, regardless of how much they have risen in value since you purchased them. This is incredibly valuable for a lot of early retirees, as it can be a tax-free source of funds to get them through beginning Social Security. It's available for married households with income under $80,000 this year, and this amount should slowly rise with inflation over time. And before we go, we want to make sure you know your options when considering this offer, because of course you don't have to accept it. If you reject the offer, know that there's no guarantee there will be another offer later. Collins Aerospace, for example, has done a few of these rounds now over the last few years, but that doesn't necessarily mean there'll be another round in the future. Because usually these offers are a sign that a company is at least under some amount of stress. They're trying to reduce the number of their employees, which is never a great sign, and if the company does not get the reduction in numbers they want, they can certainly move to more drastic measures like layoffs, which usually don't have as lucrative of terms as a voluntary separation offer that they might be offering now. So at the very least, if your company is sending out these offers to employees, and for sure if you received one, it's time to do a retirement checkup, because either way, it could be a sign that changes could be coming. If you're looking for more help on making this decision, this is what we do every day. Even if you just want to do some reading up on this topic and other financial planning topics, our blog is a whole host of information available on a wide variety of topics. If you'd like copies of these slides for reference, please send me an email and I will get them back to you. We'd be honored to help you work through this time and help you plan for retirement, whether you accept this offer or not. If you are interested, you can schedule a meeting all online through our online calendar at arnoldmoat.com, or simply send us an email or give us a call, and we look forward to talking with you. Thank you for attending and have a great day.